Hello everyone, my name is Dan the Tutor, and today I want to investigate the question, what would happen if interest rates went up to as high as 20%? According to Federal Reserve economic data, the interest rate for a home mortgage went to as high as 18.5% in October of 1981, which is the highest interest rates America has ever seen. And now, with the fiscal policy taken by the Federal Reserve, many people are wondering, are we ever going to reach that again? Are we coming to that point in the near future? Now, I have no idea what the answer to that question is, but what I want to tell you is how it can potentially impact you if you are looking for a house loan, if you do have student loans, if you are looking to pay off a car loan. Interest rates impact all of those things. And so today, I'm going to unpack exactly what that means for you. So first off, we need to understand what the Federal Reserve does. The Federal Reserve doesn't actually set the interest rates for a car loan or for a 30-year fixed mortgage, but what the Federal Reserve does is they set the federal funds rate. Now, what's that? Well, the federal funds rate is the interest rate at which banks lend to other banks. And why that matters is because the banks are the ones who actually issue those 30-year mortgages for home buyers. So if the federal funds rate goes up, it's likely we're going to see an increase in interest rates across the board because the Federal Reserve impacts the banks and the banks are the ones who issue the loans. There are many graphs out there you can Google on your own that shows the relationship between the federal funds rate changing and then the mortgage rates changing. It's not exactly a 1-to-1 ratio, meaning that if the Federal Reserve increases the federal funds rate by 1%, it doesn't necessarily mean that mortgage rates increase by exactly 1%. But what it does mean is that there's a trend. If the federal funds rate increases, it's likely that all other loan interest amounts will increase as well. Now, the reason that the Federal Reserve would do this in the first place is because they're trying to combat inflation from getting out of control, which makes sense because unless you've been living under a rock, or if you've been traveling by foot-pedaled car like from the Flintstones, then you've likely seen the out-of-control inflation that's been going on in 2022. So if the interest rates go up, people are less likely to take out these loans to buy homes or cars or build up credit card debt, which means less money is in the overall economy, and the theory is that's likely to curb inflation, which is a good thing. So the example I want to look at today is if you are a first-time home buyer and you want to buy a house. Obviously, the interest rates going up are going to affect you, but how much? How much is that going to affect my monthly payment? How much is that going to impact the overall money I'm spending between the loan and the actual price of the house? So let's start out with an easy example. Let's say you're looking for a house in the ballpark of $400,000. Or at least you decide to take out a mortgage of that amount. Maybe you spend 10% on the down payment, 20%, whatever. Your mortgage is $400,000. So that is the loan amount. Now I'm going to make a table of values and we're going to look at three things. One, we're going to look at the interest rate. Two, we're going to look at the monthly payment. And three, we're going to look at the total money spent on the loan. So we're actually going to start off with the easiest example. Let's say 0% interest. I should also mention this is for a 30-year loan, which is the most common type of home mortgage. Now, when the interest rate is 0%, it's the easiest math to do. The total money spent is going to be $400,000 because there's no interest. And the monthly payment is just going to be $400,000 divided by 30. That will get you the per year. And then divided by 12, and that will give you the monthly payment. So that'll be a monthly payment of $1,111. So there's our control, if you want to think of it like that. Now let's look at what happens when the interest rate is 1%. All of a sudden the math gets a lot more complicated. Luckily there's an equation that we can follow to calculate the monthly payment and the total money spent on the loan. Now there is a derivation to prove this equation. I think it's really complicated and not worth explaining, but here it is. The monthly payment, M, is the principal, P, which is the initial amount of the loan, so $400,000, times the monthly interest rate, which we'll get into in a second, times the quantity, 1 plus r to the nth power, where n is the number of payments, which is going to be 30 times 12, 30 years times 12 months. And then in the denominator, we have, again, 1 plus r to the n, and then you subtract 1. And this is what we use to calculate our monthly payment. Now again, P is the principal, it's the $400,000 number. R is just going to equal whatever the interest rate is divided by 12, because again, it is the monthly interest rate, which means you divide it by 12 to calculate the monthly interest rate. N is the total number of payments, which is 30 times 12, because again, 30 years times 12 months, which is 360. And so since I said the interest rate for my first example is 1, I know that the first value for R I'm going to plug in is 1%, so 0.01 divided by 12. Now you can plug this in a calculator. There are also a ton of mortgage calculators out there that use this exact equation to determine your monthly payment, so you don't even have to be a math whiz to do this stuff. So at 1% interest, after plugging in the formula, we'll get a monthly payment of $1,287, which is an increase of $176 per month. And when you multiply that number by 360, you'll get the total money spent. 1,287 times 360 gives us a total of $463,320. So even an interest rate as small as 1% means you're spending an extra $63,000 across the 30 years, which is obviously a lot of money. This stuff matters. When you hear the Fed increases interest rates by 0.75%, this is what it looks like for you, how that impacts you. Now let's go to 2%, see what we get there. At 2%, the monthly payment is $1,478, which gives us a grand total of $532,080. Look at that. That's about a $200 increase in the monthly payment, which comes out to approximately a $70,000 increase in how much you're spending over the lifetime of the loan. Now I'm going to look at 6% because that's approximately what interest rates are looking at right now for a 30-year fixed mortgage. That is going to be a steep $2,398 per month. Now I really want you to just look at this for a second and ask yourself, which of these amounts could you afford to pay? For some of you out there, maybe you're doing very well financially, or you have a spouse that can help pay off the loan, and $2,398 isn't that bad for you. But I think it's safe to say for the majority of Americans, the increase from 1% interest rates to 6% interest rates is absolutely crippling. It makes it so it's practically impossible to afford a $400,000 home unless you make at least 6 figures. And even then it's hard. And then the total for that would be $863,280. You'll notice at this point, by the way, at 6%, and probably a little before that actually, probably around 5.5%, that the total money spent is literally double the actual loan amount in the first place. That's crazy. And so finally, the last number we're going to look at. God forbid it ever reaches this high, but 20% interest rates. So again, this is close to what we were looking at in the early 1980s. Are you ready? The monthly payment is a total $6,684. I don't understand how anyone could afford a home in the 1980s. And so the total payment amount is a measly $2.4 million. 6 times the initial price of the home. And so that, my friends, is what 20% interest rates can potentially look like. And I pity anyone who's looking to buy a house in the current economy. So hopefully that explanation made sense to you. Once again, my name is Dan the Tutor. Thanks for watching, and I'll see you next time. Bye-bye.